A way of businesses acquiring protection from foreign exchange risk is by hedging. This is a strategy intended to protect a position or investment from losses. Hedges are similar to insurance, where a premium is paid to protect against losses. A form of hedging is using currency derivatives to reduce potential transaction, translation, and economic risks of currency movements that could lead to losses for a firm or investor. A derivative is a financial instrument with a price that depends on or is derived from another asset. It is typically a contractual agreement between two parties in which one party is obligated to buy or sell the underlying security and the other has the right to buy or sell the underlying security. Investors engaged in derivatives are speculators. They do trade in currencies and currency derivatives to earn profits by betting on the future price of commodities. Unlike hedgers who seek to reduce foreign exchange risk, speculators are more aggressive and intent to make a profit. Four of the most common examples of derivative instruments are forward contracts, future contracts, call and put options, and currency swaps. The table below will help clarify the difference between hedging and derivatives. Forward contracts are contracts in currencies offered by large banks in the OTC market. Forward contracts are less standardized than future contracts, such that they can be customized by the seller and the counterparty to meet the hedging needs of the buyer. Forward contracts are not marked to market daily. Marking to market refers to the daily settling of gains and losses due to changes in the market value of the security. Over-the-counter or OTC markets. Over-the-counter market or OTC markets refers to the derivatives market run by large banks. An over-the-counter derivative is a financial contract that does not trade on an asset exchange and which can be tailored to each party's needs. These are unlike future contracts, which is more formal and standardized legal instruments sold on organized exchanges. Businesses can use another way of hedging by entering into currency future contracts. This is a standardized agreement to buy or sell a specified amount of currency at a date in the future at a predetermined price. The long position is buying a currency contract and profiting on the increased value of the underlying currency over time. This is when you expect the contract value to rise in the future. The short position is selling a currency contract. You are in possession and profiting on the decreased value of the currency over time. This is when you expect the contract value to fall in the future. Future contracts are traded in organized exchanges. Organized exchanges trade future contracts in major currencies and offer price transparency and efficiency in addition to eliminating counterparty risk due to guaranteed payments on contacts. Think of organized exchanges as brokers where investors can buy future contracts. The following graph illustrates the payoff diagram of futures contracts. In the long position, you gain when the spot rate is higher than the forward rate. So as the spot rate goes up beyond the intersection P0, so does your gain. In the short position, you gain when the spot rate is lower than the forward rate. So as the spot rate goes down, further below the intersection P0, your gain goes up.